Imagine opening a corporate vault, expecting to find billions in hard currency, only to discover an empty room and a stack of forged bank statements. In the summer of 2020, the global financial system experienced exactly this shock when a towering pillar of European technology collapsed overnight. A staggering 1.9 billion euros simply vanished from the balance sheet of a company once celebrated as the future of digital payments. This was not a sophisticated heist executed by masked intruders under the cover of darkness. It was a methodical erosion of truth, orchestrated in corporate boardrooms and masked by complex financial engineering. The disappearance of that wealth exposed a labyrinth of deception that shattered trust in elite institutions and regulatory bodies worldwide. At the center of this monumental illusion stood Wirecard AG, a German payment processor that had risen from the obscure fringes of the internet to the pinnacle of the European markets. Leading this charge was Markus Braun, a charismatic Austrian executive who cultivated an aura of visionary genius. Braun transformed a modest enterprise that originally handled payments for gambling and adult entertainment websites into a financial juggernaut. He wore black turtlenecks, echoing legendary tech founders, and spoke in dense, futuristic jargon about the seamless integration of global commerce. Under his leadership, the company promised investors uninterrupted, exponential growth in an industry desperate for a European champion to rival Silicon Valley giants. To maintain this relentless trajectory of growth, the company relied on a highly opaque business model centered around third-party acquiring partners. In regions where the payment processor lacked the necessary banking licenses to handle transactions directly, it supposedly outsourced the work to local companies across Asia. These partners were claimed to handle the payment processing, take a commission, and hold the remaining profits in trust for the German parent company. On paper, this arrangement looked like a brilliant strategy for rapid, low-cost global expansion. The financial statements showed massive revenues flowing in from these distant operations, padding the bottom line and driving the stock price to dizzying new heights. The fatal flaw in this architecture of success was that the vast majority of this outsourced business was entirely fabricated. The supposed profits were nothing more than phantom cash, entries manipulated on a spreadsheet to satisfy market expectations. For years, the guardians of market integrity failed to recognize the mirage. Elite auditors, specifically the firm EY, signed off on the annual reports, providing a stamp of approval that reassured investors and creditors. The auditing process, designed to be the ultimate backstop against corporate malfeasance, instead became a rubber stamp for a multi-billion-dollar accounting fraud. The numbers were accepted at face value with devastating consequences for the global market. Piercing this veil of corporate legitimacy required extraordinary tenacity. The untold story of this collapse belongs to the persistent investigative journalists at the Financial Times, who spent over half a decade scrutinizing the company's labyrinthine accounts. Reporters noticed glaring discrepancies between the massive profits claimed in Asia and the actual physical footprint of the businesses supposedly generating them. When they visited the registered addresses of these crucial third-party partners, they did not find bustling corporate hubs. Instead, they found empty offices, residential homes, and even a retired Siemens family, unaware that their address was listed as a hub for millions of euros in digital transactions. Exposing the truth triggered a ruthless campaign of corporate retaliation. Rather than addressing the glaring anomalies in their financial reports, the executives launched a scorched earth defense against their critics. They hired aggressive law firms to threaten the journalists with ruinous defamation suits, attempting to bury the allegations under a mountain of legal intimidation. The company also deployed shadowy private intelligence firms to track the reporters, hack their communications, and orchestrate elaborate sting operations designed to discredit them. The narrative pushed by the executives was that corrupt hedge funds were conspiring with the media to illegally drive down the stock price through malicious short selling. This aggressive gaslighting campaign found an alarmingly receptive audience among government regulators. The German financial watchdog BaFin chose to protect the national champion rather than investigate the mounting evidence of multi-billion-dollar fraud in a move that shocked the global financial community. The regulator actually filed criminal complaints against the Financial Times journalists, accusing them of market manipulation. They even instituted an unprecedented ban on short-selling the company's stock, effectively shielding the fraudulent enterprise from market scrutiny. This regulatory capture demonstrated a profound systemic failure, where the desire to foster a domestic tech titan completely blinded authorities to the massive deception unfolding in front of them. The institutional blindness was compounded by a broader cultural desperation for a European success story. For decades, the continent had watched American and Asian firms dominate the digital economy. The sudden emergence of a homegrown payment processor boasting cutting-edge technology and flawless balance sheets triggered a powerful halo effect. Investors, politicians, and the public wanted so badly to believe in the narrative of a technological renaissance that they willfully ignored the red flags. This collective suspension of disbelief created an environment where skepticism was treated as treason, allowing the illusion of prosperity to inflate to catastrophic proportions. Despite the immense pressure and institutional shielding, the facade slowly began to fracture from within. Whistleblowers, operating at great personal risk, began leaking internal documents that contradicted the official narrative. These brave individuals provided the crucial evidence needed to map the intricate flow of fabricated transactions. The internal emails and spreadsheets revealed a frantic, ongoing effort by senior executives to shuffle money in circles, a practice known as round-tripping. They were taking real corporate funds, sending them to shell companies, and bringing them back as fake revenue to create the illusion of organic business growth. The mechanics of this deception relied heavily on the exploitation of international escrow accounts. To explain why the billions in Asian profits were not being repatriated to Germany, executives claimed the funds were held in specialized trust accounts in the Philippines. They produced elaborate bank confirmations and forged letters from supposed trustees, creating a paper trail that appeared legitimate to anyone who did not look too closely. This geographical distance was a deliberate feature of the scam, exploiting the natural friction and communication barriers between European auditors and Southeast Asian banking institutions to keep the fabricated wealth hidden in plain sight. The persistence of this specific illusion highlighted a critical weakness in modern auditing practices. For years, the EY auditors accepted documents provided directly by the company or by the supposed trustees without independently verifying the balances with the actual banks in the Philippines. Relying on management-provided evidence is a fundamental violation of the professional skepticism required to detect sophisticated fraud. The failure to perform the simple, mandatory step of requesting direct bank statements allowed the executives to maintain the fiction of a massive cash reserve, turning a blind eye to the very mechanisms that were meant to protect the public interest. The dam finally broke when the mounting public pressure forced the company's supervisory board to commission an independent special audit by KPMG. Unlike the regular annual reviews, this forensic investigation was specifically designed to hunt for the missing evidence of the Asian profits. After months of digging, KPMG released a devastating report stating they could not verify the existence of the revenue, nor could they trace the supposed billion-euro cash balances. The special auditors highlighted a complete lack of cooperation from the third-party partners and a glaring absence of original financial records, effectively stripping away the last remaining layers of corporate defense. Faced with the damning conclusions of the special audit, the long-standing wall of complicity finally crumbled. In June 2020, EY auditors abruptly refused to sign off on the 2019 financial statements, publicly declaring that they had been provided with spurious bank confirmation. The admission sent shockwaves through the financial world. The company was forced to issue a catastrophic press release, admitting that 1.9 billion euros listed on its balance sheet likely did not exist. In a matter of days, the narrative shifted from a temporary accounting dispute to the grim reality of a massive, systemic fabrication. The immediate fallout from this admission was a brutal, unrelenting destruction of shareholder value. The stock price plummeted by over 90% in a matter of days, vaporizing billions of euros in market capitalization. Retail investors, many of whom had trusted the reassurances of the regulators and the audited financial statements, watched their life savings evaporate. Pension funds and institutional investors were left holding worthless shares. The human toll of the collapse extended far beyond the trading floor, destroying the financial security of thousands of individuals who had placed their faith in the integrity of the European financial system. The swift collapse of the corporate empire brought an abrupt end to the reign of Markus Braun. The once celebrated visionary was arrested by German authorities, facing severe charges of market manipulation, embezzlement, and commercial gang fraud. The executive board imploded, with key figures fleeing the country to avoid prosecution. The dramatic fall from grace exposed the hollow core of the leadership team, revealing a culture of intimidation, secrecy, and relentless greed. The transition from a lauded tech pioneer to a criminal defendant marked one of the most spectacular individual downfalls in modern corporate history. The realization that the money never existed forced a painful reckoning with the nature of modern financial illusions. This was not a case of a legitimate business suffering from poor management or adverse market conditions. The core engine of profitability had been a mirage from the very beginning. The phantom cash was a symptom of a deeper disease, a systemic willingness to prioritize aggressive growth narratives over fundamental financial reality. The legacy of this collapse serves as a stark reminder that in the digital age, wealth can be fabricated just as easily as it can be destroyed, leaving behind a trail of devastation. The shockwaves of the scandal triggered a profound crisis of confidence in German regulatory oversight. The head of BaFin was forced to resign in disgrace, and the agency underwent a massive restructuring aimed at addressing its catastrophic failures. Lawmakers launched parliamentary inquiries to understand how a multi-billion-euro fraud could have flourished under the noses of the nation's top financial watchdogs. The uncomfortable truth emerged that the regulatory framework was woefully unequipped to handle complex, transnational digital business models, relying on outdated methodologies that were easily bypassed by sophisticated corporate deceivers. This regulatory reckoning extended to the global auditing profession, sparking a fierce debate about the responsibilities of financial gatekeepers. The scandal underscored the urgent need for a fundamental shift in how audits are conducted, moving away from a checklist mentality towards rigorous forensic skepticism. New standards were proposed to force auditors to actively hunt for fraud rather than simply verifying the math on management's spreadsheets. The disaster highlighted that without independent, aggressive verification of underlying assets, the entire system of corporate reporting remains dangerously vulnerable to manipulation and deceit. Understanding the mechanics of the deception also requires examining the psychological vulnerabilities of the market itself. The fraud thrived because it offered exactly what investors were desperate to buy, which was a compelling narrative of frictionless, infinite growth. The executives weaponized complexity, using the dense jargon of digital payments and the geographical distance of Asian partners to discourage critical questioning. When a business model is too complex to easily understand, the natural human tendency is to rely on the social proof of rising stock prices and the endorsements of supposed experts. This cognitive shortcut proved to be a fatal weakness. The lingering damage of this deception extends far beyond the immediate financial losses. The scandal inflicted a deep, lasting wound on the reputation of the European technology sector, casting a long shadow of suspicion over legitimate startups and innovators. Trust, once shattered on such a massive scale, is incredibly difficult to rebuild. The betrayal felt by the public reinforced a growing cynicism toward corporate elites and the institutions designed to police them. This erosion of faith in the financial system is perhaps the most toxic, enduring legacy of the entire fabricated enterprise. Yet, amid the systemic failures, the eventual exposure of the truth stands as a testament to the vital importance of independent scrutiny. The vindication of the persistent investigative journalists demonstrated that even the most well-funded corporate cover-ups can be dismantled by rigorous, evidence-based reporting. Their refusal to back down in the face of legal threats, physical surveillance, and regulatory attacks provided a blueprint for how complex financial crimes must be investigated. The breaking of the scandal proved that transparency is not a natural state of corporate affairs, but rather a condition that must be actively fought for and aggressively defended. For the individual investor, the lessons extracted from this disaster are both urgent and empowering. The primary defense against such sophisticated deception is the cultivation of relentless skepticism. When a company's financial performance appears completely decoupled from its physical operations, or when its business model defies simple explanation, those anomalies must be treated as glaring warning signs. Financial literacy now demands an understanding that audited statements are not infallible guarantees of truth. Investors must learn to look past the charismatic leadership and the aggressive growth projections to demand concrete, verifiable evidence of underlying value. The history of financial markets is punctuated by spectacular frauds, from the Ponzi schemes of the early 20th century to the massive accounting scandals of the early 2000s. Yet this specific collapse represents a dangerous evolution in the anatomy of deception. By leveraging the intangible nature of digital payments and the fragmented jurisdiction of global finance, the perpetrators created a modern transnational illusion that bypassed traditional safeguards. It serves as a textbook case study in how the speed and complexity of the modern digital economy can be weaponized to scale fraud to unprecedented heights. The pursuit of justice in the wake of the collapse remains a complex, ongoing battle. While key executives face lengthy criminal trials, others vanished into the shadows of international safe havens, triggering global manhunts. The sprawling legal proceeding are meticulously unpacking the precise mechanisms of the fraud, ensuring that the intricate details of the deception become a matter of permanent public record. These trials serve a dual purpose, punishing the architects of the illusion and providing a detailed autopsy of the crime to help fortify the financial system against future attacks. Ultimately, the resilience of the global economy depends on closing the gaps exposed by this massive fabrication. Regulators and policymakers are now tasked with building a framework capable of monitoring decentralized, digital-first business models. This requires international cooperation, advanced data analytics, and a fundamental willingness to challenge domestic corporate champions. The era of accepting complex financial engineering at face value has ended, replaced by a harsh understanding that without aggressive cross-border oversight, the next phantom enterprise is already being constructed. The true defense against the next great corporate illusion lies in collective vigilance. It requires a financial ecosystem where whistleblowers are protected, journalists are free to investigate without intimidation, and auditors are held strictly accountable for their failures. The story of the missing billions is a powerful reminder that prosperity built on a foundation of lies will inevitably collapse, and the cost of that collapse is always borne by the public. By understanding the anatomy of this deception, we arm ourselves against the psychological manipulations and systemic blind spots that allow such frauds to flourish. The shadows of corporate deception are constantly shifting, finding new avenues to exploit trust and fabricate wealth. Recognizing the patterns of the past is the only way to illuminate the threats of the future. As the methods of financial manipulation grow more sophisticated, so too must our capacity for critical analysis and unwavering skepticism. The fight to protect the integrity of the market is an ongoing, vital endeavor. News Stories Weekly. Stay one step ahead of the fraud. Subscribe.